Hello, welcome learners. And at the end of the discussion on income from other sources, I thought that let me discuss some issues which have come in Budget 2019 so that you are updated about the changes that have been brought by Budget 2019. The first one that is important to discuss is that there is no change in the income tax slabs. However, there is a tax on super rich, that is, those earning more than rupees 2 crores but less than rupees 5 crore, and those earning more than rupees 5 crore have to pay a higher amount of surcharge. But for the lower level of income earners, individuals whose taxable income does not exceed rupees 5 lakhs will continue to avail the tax rebate and thereby will pay zero tax. I think it would be clear if I show you a table. This table shows that income up to rupees 2.5 lakhs tax rate is nil. There is no surcharge, there is no cess. From 2,50,001 to rupees 5 lakhs, the tax rate is 5% and there is no surcharge, though there is the cess, education cess is 4%, but rebate up to rupees 12,50,000 is available for those whose net taxable income does not exceed rupees 5 lakhs. That means any person earning income up to rupees 5 lakhs need not pay any amount of tax because the tax rebate amount is increased. But if a person earns more than rupees 5 lakhs, then this tax slab will be applicable. In that case, that person has to pay 5% tax on this slab 2,50,001 to rupees 5 lakhs. So this is the difference. So we cannot straight away say that the exemption limit is rupees 5 lakhs. No, any a person earning income up to rupees 5 lakhs need not pay tax, but exemption limit is rupees 2,50,000. So as it is a progressive rate of taxation, the tax rate increases from 5%, next is 20%, there is no 10% slab, next is 30%, which is the maximum. So if a person earns up to rupees 50 lakhs, the tax rate will be 30% for the amount exceeding rupees 10 lakhs and there is no surcharge. But if the income is more than rupees 50 lakhs, then the surcharge comes 10% and the surcharge gradually increases to 15%, 25%, 37%. That is more than rupees 5 crore, the surcharge will be 37% of the tax. So, but in all the cases, the cess is 4%. Now, what happens if we see that due to this increased introduced surcharge, those with incomes between rupees 2 crores and 5 crores will effectively have to pay 39% as tax, and those with income more than rupees 5 crore will have to pay 42% of tax. So thus the tax burden on super rich is made a bit higher. Now to say that there are certain other changes which are being brought in, we can say that NPS withdrawal, NPS is the National Pension System, it becomes tax free. That is, those investing in the national pension system have another reason to cheer in this year's budget 2009. And it has finally announced the move to make lump sum withdrawals at the time of maturity as tax exempt. NPS at the time of maturity allows investor to withdraw 60% of the corpus as lump sum and the remaining 40% to be used as compulsory by annuity plan. Those learners who want to know more about the NPS can read. As per current law, 40% of the lump sum withdrawal is tax exempt from the 60% corpus. And also the contribution to the NPS comes under the deductions under section 80C. We can see the other changes, that additional tax break for buying an affordable house. As announced in budget 2019, an individual can claim an additional deduction of 1.5 lakhs on interest paid on home loan under the newly introduced section 80EEA. This is a newly introduced section, but there are certain conditions. The conditions are that the loan must be taken between April 1, 2019 and March 31, 2020. The learners, you can help others to suggest that if a housing loan is taken between April 1, 2019 and March 31, 2020, the value of the property must not exceed rupees 45 lakhs. Individuals should not own any house on the date of sanctioning of the loan. These are the three tough conditions, of course. In that case, section 80EEA gives that additional deduction of rupees 1.5 lakhs is available over and above existing rupees 2 lakh deduction on the home loan interest paid under section 24. That means if a person does not own a residential house and wishes to buy a house, and if he or she can take a loan during the period April 1, 2019 to March 31, 2020 for a house property of rupees 45 lakhs, in that case he or she can claim a total deduction of 3.5 lakhs of interest payment on loan under section 24. That is income from house property, the deduction is 2 lakhs. And additionally, under section 80, specifically 80EEA, additional deduction of rupees 1.5 lakhs is possible. So this is the changes that has been brought. Another thing, to discourage cash transactions and to push digital payments, Budget 2019 has proposed to impose tax deduction at source at the rate of 2% if the total cash withdrawn in a financial year exceeds rupees 1 crore from a bank or post office or a cooperative bank from a single account. However, this proposal will come into effect from September 1, 2019, and this is only a TDS, and this is not a tax. Just to track the cash transactions, the government has imposed 2% TDS for withdrawing cash from bank accounts. Another important thing which is there is that ITR filing is made mandatory in certain cases. As per the current laws, a person is required to file ITR if his or her total income exceeds maximum income not chargeable to tax, subject to certain exceptions, like at this moment 2,50,000 is the exemption limit. But even if a person does not reach that amount of income, but if the amount deposited in current account held with bank or cooperative bank exceeds rupees 1 crore in any financial year, expenditure incurred on foreign travel exceeds rupees 12 lakh in a financial year, if an individual incurs an electricity bill of rupees 1 lakh or more in a year, claiming capital gains exemption on investment on a house, in that case, even if their income does not reach the exemption limit, even then, these persons will be required to file mandatorily the income tax return. So this is the new insertion. Parking and other charges come under the ambit of TDS. With effect from September 1, 2019, any payment made towards buying of property, including payments made with respect to amenities such as club membership fees, club parking fees, electricity and water maintenance fees, etc., to ascertain the amount of TDS to be deducted while making the payment. Now, currently, tax is deducted only for the payment made with respect to property, and other payments made for services are not included. So this is a particular step towards making tax compliance more wider, as well as TDS on payments exceeding rupees 50 lakh to contractor. That is individuals and Hindu undivided families with effect from 1st September 2019 will have to deduct tax at the rate of 5% for payments made to contractors and other professionals if it exceeds rupees 50 lakhs in a year. Presently, individuals and HUFs are not required to deduct tax at source on payments made to contractor and professionals. NRIs to pay tax on gift received by resident Indians. As per budget proposals, gift received by non-resident Indians, that is NRIs, from someone residing in India will come under the tax ambit. As per budget documents, this will apply for the money paid or property situated in India transferred on or after July 5, 2019. Now, to give relief to the salaried class. In my first week classes, I have shown some data which was presented by the then Finance Minister Arun Jaitley, who says that 76 lakhs people only showed income tax return, that is, they are earning more than rupees 5 lakhs, which is unbelievable. And irony is that out of 76 lakhs, 56 lakhs are salaried employees. So it is a fact that majority of the income tax has been collected from the salaried employees because their incomes are transparent. So salaried employees need to be given some kind of relief. So standard deduction was introduced 2 years back. It was rupees 40,000, and now this budget has increased the deduction of salary from rupees 40,000 to rupees 50,000 for the next financial year. No tax on national rent. This is another good news. That is, if a person owns two houses which are under residential accommodation of self, earlier only one house was taken as self-occupied and its gross annual value was taken as nil. Other house was taken as a deemed to be let out and national rent was to be charged as tax. Now this year budget proposed that you will not be required to pay tax on national rent or deemed rent on your second house if it is lying vacant. So a person can show gross annual value nil in two self-occupied properties instead of one as earlier. I have already discussed it in the capital gains chapter, but even then to repeat that, if you sold a house and then to save tax, you can invest in long-term capital gain. And this year it is allowed in two houses instead of one earlier. However, this can be availed if capital gains do not exceed rupees 2 crore and it is once in a lifetime of an individual. So these are some of the benefits which are given or in the newly placed budget by the Union Finance Minister, Ms. Nirmala Sitharaman, and will be applicable for the next assessment year. So I thought learners should know these things before we close our discussions on incomes from different heads. Thank you.